Major changes are coming to the federal student loan system this week. Starting Wednesday, eligibility rules are changing for millions of current and future borrowers. So listen up. The Education Department is eliminating the SAVE plan. Borrowers enrolled in the income contingent repayment or the pay-as-you-earn plans will also be impacted. Those changes could come with higher repayment requirements, more loan limits, and fewer program options. So here to break this all down is national higher education reporter Danielle Douglas-Gabriel. Danielle, tell us what people might expect to see on July 1st when they log on to their accounts. What are the major changes they should look out for?
So there are a couple of major changes that are happening July 1st. One, of course, is that people who are enrolled in the SAFE plan, as you mentioned, will start getting notices from their student loan servicers saying you have about 90 days to switch out off of this plan because it's ending onto one of the current plans that exist, including two new plans that were created by Congress through the reconciliation bill. One is a standard repayment plan that can stretch out your payments to, I think, about 25 years, depending on the size of your loan. And the other one is an income-based plan called repayment assistance protection, as RAP is commonly known. And it's not quite as generous as the SAVE plan. So in comparison, a lot of borrowers who are on SAVE who might want to switch to RAP will likely see an increase in their monthly bill. But there are some protections, including an interest subsidy, so that if you pay your bills on time every month, the government will cover any unpaid interest that's accumulated on the bill. The other thing I think a lot of borrowers need to be aware of is that starting July 1st, the Education Department is instituting a 2-year interest discount. What this means is that if you go on auto pay and have your payments withdrawn from your bank account every month for the next 2 years, you get a 1% discount off of your interest rate. So if you are have a loan that's 7%, you will it'll actually be 6% if you sign up for this plan and remain timely on your payments. That could be a pretty important discount and savings for a lot of people over the life of their loan. So it's something to take into consideration as well.
That does sound like something people should try to do if they can.
Yeah.
Tell us a little bit more about what the SAVE plan is or was, since it's about to be gotten rid of. And is it basically the income contingent plan that I remember being on?
So it is the super generous version of the income contingent plan. There are about 4 different income-driven repayment plans. One was income contingent, pay as you earn, repay was one that got kind of folded into SAVE, and then income-based repayment. What SAVE did that was so different, remarkably different than the other plans, is that it offered you a faster path to debt forgiveness as well as lower monthly bills. It took into account a smaller percentage of your discretionary income in order to calculate your monthly payments. And for people who had low balance loans, you could get your loans forgiven faster, like after 10 years of repayment. And so it created a lot of problems in terms of a lot of conservative states thought that the department overstepped its authority by creating this plan. Ultimately, the court sided with those who are detractors of this plan, and now we are seeing it come to an end.
A lot of people are also confused about the 90-day period. Explain that timeline when people actually have to pick a new plan and when the new loan repayments and those plan terms go into effect.
Sure. So notices start going out on July 1st, but not all at once. It's going to be staggered. So if you are a borrower on SAVE, you may not receive a notice until July 15th or the end of July. And from that point on is when the 90-day clock starts ticking for you to start switching off of the plan. The department anticipates that there's going to be some lag time for a lot of borrowers. And so in a court filing recently, they actually said that they think that the end of September is the earliest they expect people to get off the SAVE, but they expect that there will be some people who are still struggling to switch over and won't necessarily be penalized for doing so. The thing is, because of all of these changes that are happening all at once, there is some anticipation that it'll take folks a little while to kind of get their bearings and figure out what's the best plan for them. The student loan estimator, which is this fantastic tool that kind of gives you a sense of which plan would be most affordable for you, is one of the ways that borrowers can start to look at what's available does it fit their household budget, and how they could start to plan from here on out. You can find that at studentaid.gov, and you could also contact your student loan servicer to ask for assistance and guidance in this process.
So much good information. Danielle Douglas-Gabriel, thank you so much.
It's great.
And yet
You're
still,
welcome.
interest rates are so high for student loans, higher than mortgages. I'm still shocked by it.
I know. It's a real, I mean, in this country, the fact that it costs so much to go to school and then you have to pay these interest rates if you take out loans is nuts. Thank you, Jennifer.